vibration that lets success soar high. I will achieve, I will fly high. In SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show, where we bring you the story behind the latest developments in the banking sector. It is the 19th of October and I am Ruchika Chakravanshi. In today's episode, we will talk about what is behind RBI's recent bans on financial sector entities. In Banker's View, we have with us Bipin Preet Singh, co-founder and CEO of Mobikwik. Our Banking for You today will tell you all about the RBI's open market operations. For our expert take, Tamal Bandyopadhyay joins us again to talk about HDFC results, future of rupee and RBI's new investment norm. At the end of the show, we will tell you the results of last week's poll and the question for this week. On 10th October, the Reserve Bank of India directed the Bank of Baroda to suspend further onboarding of customers onto its mobile banking application. RBI said that the action was based on material concerns regarding the manner in which the onboarding was being conducted. In recent years, the central bank has placed similar embargoes on a number of financial sector entities, including Fino Payments Bank, HDFC Bank, and Paytm's Payment Bank. Against this backdrop, why are banks and financial services firms in RBI's line of fire, and what is the way forward?
The Reserve Bank of India's decision to ban state-owned lender Bank of Baroda from onboarding new customers on its mobile app is in line with the central bank's actions against other financial sector firms in recent years. The move reflects the RBI's concern that the pace at which these entities are setting up technology and governance guardrails is much slower than the rate at which consumers are adopting digital financial services. On 10th October, the RBI barred Bank of Baroda from onboarding new customers on its mobile app BOB World, citing material supervisory concerns. The RBI also directed the bank to ensure that the onboarded customers should not face any disruption on account of this suspension. And this is not the first instance. In December 2020, the RBI barred HDFC Bank from issuing new credit cards and launching new digital initiatives. It took the step after the bank's customers faced repeated technical outages in internet banking, mobile banking, and payment utilities. The regulator partially lifted the ban on card issuances in August 2021 following remedial action. The ban on new tech initiatives was lifted later in 2022. Policy researcher Srinath Sridharan shares his perspective on how the RBI acts as the custodian of consumer trust here.
So RBI is almost the custodian of consumer trust about everything financial in India. So from that point of view, if there is any deviation, whether it is about operational issues, risk mitigation, challenges of digital, IT, technology, emerging technology risk, or even human risks, I think RBI is very clear in its supervisory mandate that anything that brings to their attention deviations from these, they want to take action on this. And that is what we are seeing of it. Banks have been using technologies for decades. So that transition they need to make. And I think here they did not expect the velocity of change of consumer adoption. Consumers are far more digital today than reality is most of the banks or most of the NBFCs. And I think that is a challenge that RBI is asking these entities, saying that if you cannot measure up to these standards, I will penalize you.
RBI has, last year they came out with the report on digital lending, and then they issued circular in September 2022 on norms governing digital lending. And this year, again, they have come out with further guidelines on business correspondence arrangement and FLDG arrangements. And though RBI has not restricted use of technology because you cannot control that, but RBI has been very sensitive and very strict as regards protection of interest of consumers.
The latest economic survey points that India had the highest financial technology adoption rate in the world. According to the survey, India's fintech adoption rate among the public stood at 87% compared to the global average of 64%. India is placed third in digital payments behind only the US and China. However, India still has an untapped market which is driving financial institutions to invest in digital offerings at breakneck speed in a bid to onboard more customers and secure higher growth. For select entities, the problem is their speed of adoption has far outpaced their efforts to place technological guardrails to protect consumers.
We recently saw one of the public sector bank having an issue with RBI and falling under its regulatory action. That was not a problem of digital alone, right? It was actually a problem of setting such humongous human targets, and almost everybody wanted to game the system to meet those targets. So some of these unrealistic business numbers also will make the bank or the NBFC crack. And which is why, if you remember, RBI has always never been greatly fond of the word called valuation or the word called extreme high growth. They've always wanted steady, consistent growth for their regulated entities.
The vulnerabilities that greater adoption of fintech brings with it have also intensified concerns on the governance front. Against this backdrop, the RBI has been emphasizing the importance of governance in banks and the role of the boards. During his address to the boards of public sector banks in May 2023, RBI Governor Shaktikanta Das had said that the board's focus should be adoption of fair practices and customer protection.
I anticipate the supervisory scrutiny of RBI and the other two financial regulators in India to be far more higher, and I'm hoping that it becomes activity-based supervision, not entity-based. There's nothing called, can I go to business standard and supervise it? I will have to supervise what, when the news is coming on the internet, whoever has written it, can I actually check it? I mean, that's activity-based supervision versus entity-based.
According to global brokerage Macquarie Capital Securities, it took over 15 months for the RBI to lift the ban on HDFC Bank's new digital services. This highlights the regulator's stringent evaluation before revoking such bans. It's about time financial sector entities meet the consumer protection requirements of fintechs to align with regulatory expectations.
Moving on, Mobikwik, which started with providing wallet services in its initial days, now has 140 million users who use the Mobikwik app for money transfers, bill payment and recharge, among other things, and has a network of over 3 million merchants. In our Banker's View today, Manojit Saha caught up with Mobikwik's co-founder and CEO Bipin Preet Singh on his future plans and changing market perception of startups as cash burning and unprofitable. Over to Manojit.
Hello and welcome to the Business Standard Banking Show. Mobikwik, a fintech flair that offers digital loans and payment services, reported 2 consecutive quarters of net profit, April, June and July, September. In the second quarter, its revenue was 208 crore, which is 17% growth over the same period of last year. Bipin Preet Singh, co-founder and CEO of Mobikwik, is here with us today to share the company's strategy and future plans. Mr. Singh, welcome to the show.
Thank you. Thank you for hosting me.
Let me start with the Q2 numbers, which was the second successive quarter that the company recorded profit. Which part of your business is generating most of the profits?
So we had planned many years ago that we will not be only a payments platform. Mobikwik started as a payments platform providing wallet services initially, also payment aggregation services. So we have more than 140 million users who use Mobikwik app for various kind of use cases like money transfer, bill payments, recharges and all. And also we have a network of 3 million plus merchants where customers can go and pay using QR code or online large merchants like Make My Trip or a Zomato or different kind of use cases. So our starting of the business was always about making payments easy and accessible and safe for the customers. But as we go along, we discovered that payments is not a very high margin business, right?
Right.
And also what we realized is that in India, the penetration of financial products and financial services, especially credit, but also investments and savings, is not very high. And that is borne out by the numbers. So basically in India, less than 100 million people have really good access to unsecured credit. Even on the investment side, very few people, I would say less than 50 million people, less than 5 crore people actively invest money to make returns. Otherwise, their money is just lying in their bank accounts or in the fixed deposits. So we have taken many years ago this vision of growing Mobikwik into a digital banking platform where a customer may come on Mobikwik for making payments, but eventually they get access to all kinds of financial products, starting with credit. And credit, we have two products, pay later as well as personal loans. We work with other lenders, large NBFCs and banks, and we provide access to credit to these customers using this Mobikwik Zip, which is a pay later product, and Zip EMI, which is a higher ticket loan product. So our business performance has been actually largely guided by a very good growth in digital credit. But at the same time, even payments, we are seeing significant double-digit growth year on year.
Now, recently, there was a fintech which has been given a no objection certificate from the Reserve Bank of India to merge with a small finance bank. How do you see this development?
I think it's an excellent development. See, when we started Mobikwik, there was no such thing as a fintech. For a market like India, trust is a very important thing. And technology companies, including startups, etc., have had to earn that trust because they don't have the trust, implicit trust that comes from being a bank or having that license where people say, okay, XYZ bank, and so, your money will be taken care of. We have had to earn that trust in a very hard way by making user experience easy, getting people on board, letting them transact, letting them get the right experience. And therefore, we were able to build up. And there are many such other companies. So this merger actually signifies that fintechs have arrived. It means that they have the right to play in the financial services market in a major way, and they can be trusted the same way as you can trust, banks and other more regulated kind of entities, but especially banks, because bank is the ultimate trust institution in financial markets. So I see this that from a regulatory point of view, from an ecosystem point of view, this is a very positive sign.
Right.
It means that more and more fintechs can think in this direction if they want to, and can build proper businesses over the next decade or so.
Have you thought of entering the banking sector? Because the licensing process is now simplified, which is available on tap now.
So currently, we are focused on playing on our strengths, which is technology, and building a large profitable business by working with banks as well as non-banks, NBFCs for loans. But essentially, our role, the way we see it, is more of an intermediary. So
Okay.
as a bank, as a fintech, or even as a payment player, we actually just transfer money from one place to another, right?
Right.
We just take money from one account and take it to another account. Holding money in the account as deposits and as a bank and building that institution is an altogether different game. Although we have, also gone to a different level in terms of the scale at which we operate, right? I mean, like you said, about being profitable and scaling up the business, we have done tremendously well. But we will look at whether there is an opportunity for something like this in the future. But as of now, there is no such plan.
Now that Mobikwik is making profits, consecutive 2 quarters of profit, do you think it's time now to revive the IPO plans? You deferred the IPO in November last year.
So we have maintained that we are going to go into an IPO. As you know, in 2021, we filed for the IPO and we came very near to going public. And in the process, we did all the steps necessary to go public. Corporate governance, independent board, shareholding, everything, accounting, etc. And we continue to follow those standards. So we believe we can go public anytime we wish to. But as of now, what we are looking at is that we need to demonstrate an important thing for the markets, because in the markets, the startups are still considered as companies which are cash burning and unprofitable and just using investor money and burning it. That perception needs to change, and we are trying to change that by building a business which has both the elements, growth as well as profitability. So I think we are thinking that we will maintain this for a few more quarters, and then we will take the call.
Few more quarters of profitability. On that note, Mr. Singh, thank you very much for speaking to Business Standard. It was pleasure talking to you.
Thank you. Thanks, Manojit. Thanks for hosting me.
Earlier this month, the Reserve Bank of India announced an open market operation for the sale of government securities to manage liquidity. There is no explicit calendar for the RBI's open market operations, and the central bank can use this to adjust the rupee liquidity conditions. In Banking for You today, we will tell you all about what these open market operations are all about.
At the recent outcome of the Monetary Policy Committee meeting on 6th October, the Reserve Bank of India announced that it will be considering open market operation or OMO sales of government securities to manage liquidity in the banking system. This announcement was consistent with the MPC's stance of withdrawal of accommodation. The announcement implies that the central bank may use OMO sales as a policy tool to keep banking system liquidity in check to address higher inflation risks. So what are open market operations? Open market operations are a key monetary policy tool used by the RBI to manage liquidity or money supply in the banking system on a durable basis, thereby adjusting interest rates in the economy and controlling inflation. The central bank conducts open market operations by selling or purchasing government securities in the secondary market with financial institutions. When the banking system has an excess money supply, the RBI sells government securities like bonds and treasury bills, thereby sucking out the liquidity. Similarly, when liquidity conditions are tight, the RBI may buy securities from the market to infuse liquidity into the system. Now, how does this monetary policy strategy affect interest rates? Liquidity and interest rates are inversely proportional. This means that when the central bank buys government securities through an open market purchase from financial institutions, it increases the supply of money in circulation, which in turn helps lower interest rates. Lower interest rates imply a lower cost of borrowing, which helps stimulate borrowing and spending activity. Conversely, when the RBI conducts open market sales of government securities, it reduces the money in circulation, thereby causing interest rates to rise. With higher interest rates, borrowing becomes more expensive, slows down borrowing and spending activity, and thus helps cool down an overheating economy. Even though RBI Governor Shaktikanta Das did not announce a specific timeline or the quantum of OMO sales at the Monetary Policy Review, bond market was taken by surprise, anticipating a spike in bond yields. Experts believe the central bank may actively use OMO sales for liquidity management to achieve the 4% inflation target. India's retail inflation eased to 5.02% in September as against 6.83% in August.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
RBI's latest open market operation had surprised the bond market, and yield on the 10-year government bonds shot up by 12 basis points to 7.34%. RBI had also recently introduced norms for the classification, valuation, and operation of investment. In our expert trick today, our consulting editor Tamal Bandyopadhyay demystifies these norms and more. Here's the chat. Hi Tamal, welcome to the Business Standard Banking Show. This week in your column, you've talked about the new pitch for bond dealers to bat on. While you're talking about some of the changes that have been brought in by RBI, can you demystify for us what these changes are and what are the macroeconomic implications?
Yeah, thanks, Ruchika. It's little technical. Reserve Bank of India has changed the norms for bond buying by banks to be in sync with the global norms. It had issued a sort of discussion paper before, and now it's the final form taking effect from April next year. Now, there are multiple things. Let's not get into all. Three important things that I want to highlight. One is that bonds under the so-called HTM category, held to maturity category, on which a bank does not need to make mark-to-market losses. Now, what is mark-to-market losses is essentially a bond is bought at certain price, and if the prices goes up or goes down, accordingly, it has to make provision for that. So that's what if it goes down, then it's a loss. Now, it says that you can have your entire bond portfolio even under the HTM, which means banks will not be scared of mark-to-market losses, and they can put more banks in the HTM category. What is more interesting is not only the government bonds, even the corporate bonds also can be under the HTM category, which means even for corporate bonds, there is no scope of mark-to-market losses, even if the bond prices fall. Now, this will give a tremendous boost to the corporate bond market, because you know that despite the best efforts of markets regulator and banking regulators, bankers are not very forthcoming for buying corporate bonds. Instead, they will give you loan, because in the bond, if they invest in bond and keep it in the investment book, they suffer the risk of mark-to-market losses. Why do they do that? They will keep it in the loan book. Now, that's all good, but the point is there is I think there is a risk also. There is a challenge also for the RBI, because once you have put everything in the mark-to-market in the HTM box, what happens is this: you really don't care about whether the bond prices are going up or going down. But if you are not a good risk manager, the asset liability mismatch can happen. And that's what happened in the Silicon Valley Bank. Silicon Valley Bank put most of its money in the bond market, and that bond prices slipped, and it was suffering on a huge mark-to-market losses. And that point of time, the depositors wanted to have the money, but they didn't have the money because they have to make good the losses. They didn't have the capital. And the 40-year-old California-based bank, a very large US bank, went belly up. So RBI, of course, is much more vigilant here. I don't think we will see this kind of thing, but there is a challenge to it. So these are the first two aspects: corporate bond and government bond. It's both good and bad. And the third thing I would like to say that, which is only good, not bad. So that's the thing that the banks which you can trade, now there's a cap. Within 90 days, you have to do that. You cannot go it beyond. Now, RBI said, no, there is no cap at all. You can trade at any given point of time, which means you can keep a bond on your books meant for trading. I don't want to discuss all these technical terms of the basket's name, etc., but meant for trading for 180 days, for 1 year, etc. So that will give a tremendous boost to the liquidity in the market.
I want to talk to you about rupee. What do you think is the future of rupee now? It has been slipping. So can you share your thoughts on that?
Currency, I don't know, but yes, rupee has been sleeping. And if you have noticed that in the past 1 month, the Reserve Bank of India's foreign exchange reserves has gone down by more than 14 billion. After a long time, this kind of impact happened. Now, there is a twofold, there is two reasons behind that. One is the valuation going down, so that once the valuation goes down, there's an impact on that. And second is this: Reserve Bank of India has been in the market selling dollar. So what are the key reasons at this point of time we have seen is one is the geopolitics. primarily the geopolitics. We have been talking about Russia and Ukraine, and now of course Israel is there, and you must notice that the oil price is sleeping. Oil price again crossed 90, which RBI projection has been 85. So this combination, there is a demand for dollar is rising, and some of the other emerging markets currencies are also sleeping. RBI has been holding on at a certain level, certain band, and that's been doing. So the way forward is, I would like to believe, till this geopolitical issues continue, and if there is no let up in the rising price of oil, we will see Reserve Bank of India a little more, I will not call it aggressive, but continues to be present in the market, and that will impact our foreign exchange reserves. But the good story is that despite the slippage, both in currency as well as foreign exchange reserves, our reserves are pretty good.
The third thing that we want to talk about today, Tamal, are the HDFC results, which came earlier this week. The net profit has risen by 51%. Now, this is India's most valued bank. Can you share some of the key highlights from there?
Yeah, it is not only India's most valued bank, it will be probably one of the top half a dozen most valued banks globally. Probably you will see that. Probably that's the case. 51% net profit growth is not exactly correct, because because it's not comparable. There are multiple issues you need to check in. This is the first time post-merger. That's why it's very important it's very important results. So I will not give much importance to the net profit as such. Actually, on a like-to-like basis, net profit is up around 10%. But the other few things we need to, I will not say concern, but we need to take note of, and they are on the expected line. One is the net interest margin has slipped. HDFC's net, I don't know when did it slip last, because it did slip this quarter. That's point number one. Point number two is this NPA gone up, and point number three is that the CASA ratio, that's a low cost, which HDFC, the CASA word is probably coined by HDFC in 90s, which is current and savings account, has gone down. So these are the three key things. All three are a little challenges, but they are on the expected line because of the merger. Because on the liability side, it has got a lot of debt, which is not low cost. So obviously that has impacted their CASA as well as NIM. And again, the bad loans also have come from that other book. So these are the three things. So HDFC, this is all fallout of the HDFC merger. And I would like to believe it will take time, because the merger will be in the market's term value accretive for the investors, not overnight, because there are challenges. And we will, in the next few quarters also, we will see HDFC Bank tackling these challenges.
All right. Now, that's quite a good roundup of the banking sector this week, Tamal. Thank you so much for sharing all the details. We understand RBI is now trying to match up with global standards. And you laid out very well what the pros and cons are of all these different investments, the investment classifications that have been launched by RBI, and same about the HDFC Bank's results as well, giving a full picture, things to watch out for amid all the green shoots. Thank you so much, Tamal, for joining us today. It is time now for our poll results. Here's what we asked you last week. Have you availed credit from fintech NBFCs? 23% of our respondents said yes, they had, while 77% said no, they had not taken credit from fintech NBFCs. Of late, many financial sector entities have faced embargoes by the RBI. Some of the issues have had to do with customer interface. In light of these developments, which we also touched upon in our cover story today, here's what we are asking you this week. Do you feel your online banking is secure? Our poll is open from today, that is Thursday, and you can respond on Twitter, Instagram, LinkedIn, Telegram, and our website. We will be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.